Live. Welcome, everybody.
Howdy.
We are recording this episode today on August 11th, 2020. It is 7 a.m. here and 6 a.m. where Hari sits. Welcome,
It's
everybody.
actually 2022. Becca's
2020.
living in a cave since COVID hit. So
COVID hit, and the perception of time has been altered a little bit.
yeah,
Anyway, welcome, everybody, to the podcast. We got a lot of things to talk about today. The first one that we want to talk about is stock buyback. The I keep saying Anti-Inflation Act, Inflation Reduction Act. A big part of that is the stock buybacks, the new tax rule around stock buybacks, and we want to talk about how that might impact how companies operate and how it impacts shareholders and investors. That's one thing we want to talk about. And we also want to talk about the general state of the economy. Where are we right now? We just got a new inflation print yesterday. Was it yesterday or 2 days ago? 2 days ago.
yesterday.
Was it yesterday? Okay, yeah. We got it yesterday, so we'll talk about what that means, kind of the macro backdrop. And then lastly, we'll do this with every podcast, with every episode. We'll cover one particular company. And like we did in the previous episode, we'll kind of get into the numbers a little bit. This time around, we want to look at Disney and specifically their streaming business and kind of talk through their performance last quarter and what that means for the future. They just reported their earnings yesterday. So we'll talk about those three things. So let's get started. Stock buybacks. So Hari, let's start here. I'm going to say Anti-Inflation Act, whatever. Same
It's all
thing.
good.
Anti-Inflation Act. How is it anti-inflation? Like, what is the actual kind of proposed anti-inflation measures here?
Yeah. So I think there's the main thing is around healthcare spending around drug programs. So the way it typically works is that drug companies set their own prices in the U.S. and there's limited, controls that are put in place around those. Which in a market-based economy like the United States, that makes a lot of sense, right? So there's a couple of areas that people need to kind of pay attention to with that, which is especially if you're looking to invest in drug companies, Medicare is the one that is allowed to negotiate drug prices for at first a few handful of drugs, and then the number of drugs will increase over time. So with Medicare being able to reduce the price on drugs, they are able to negotiate prices and keep things low. The problem is that the private sector doesn't, and private insurance doesn't have that same price control. So effectively what is going to happen is Medicare will be able to control their cost, but it'll be passed along to private insurance to cover some of that expense. So the idea here is that you're going to reduce the cost, but it's only 6 drugs to begin with, and then it as it gets bigger, it'll cover more things. So there's a couple problems with this. One of the biggest problems right now is that the United States pays a lot of money for drugs because the US doesn't have these price controls. Other countries do, and so what ends up have price controls, so they essentially the US is subsidizing the price of drugs for the rest of the world, right? They pay a lot here in the United States, and then Canada and other countries pay a lot less. So we're trying to put those price controls. What'll happen is if drug companies want to maintain their profits, they'll shift the cost to the other drugs that are in the marketplace because they want to keep enough money to put into R&D and marketing and all of the things that they have to do. So, I mean, if you look at the actual net benefit, I don't see that there's going to be much benefit in actually controlling inflation, right?
Let's talk about yes. I just wanted to kind of touch on that real quick. I don't think we have to get into it, but let's talk about the other piece of this, which is they're going to raise. How are they going to fund? How are they going to
Right.
get enough cash to fund for all these operations?
Yeah.
There's a whole bunch of climate stuff in there, and this is where we talk about the stock buyback tax, the new proposed stock buyback tax. I think this is a particular interest to us as investors who we had a whole episode on share cannibals, and stock buybacks as a great way to return excess cash to shareholders. This kind of goes against that line of thinking, so I think we should really spend some time thinking about this.
Yeah.
Maybe how about we start here, high level? What is stock buyback?
So, if you remember one of our earliest episodes, we talked a lot about, what is the actual share of a company mean, right? And so imagine if you had a company and you had, Becco and I own a company and we each own 50 shares, right? Or let's say we had a third partner and we each own 33 shares, right? So if that partner decides to leave, right, what you're essentially doing is saying that that partner can sell to a third party, right? So then the split would be equal. Or Becco and I could offer to buy the shares of that person. Now let's say Becco doesn't want them, so I buy a third, right? I now own 2/3 and the other person owns 1/3, right? In essence, that's all a stock buyback is, right? Is there's somebody in the marketplace who has, there's, let's say, a publicly traded company has 100 shares. Those shares are being transacted daily and, in volume of millions of shares. All the company is doing is buying those shares for the purposes of either offsetting shares that they've issued, or to just overall reduce the number of shares outstanding so that each owner uh, of the existing business gets to have more of the business, right? So in the first case, I bought those shares, I got more of the business, right? So I could own more of the business as a percentage. And this is actually a fantastic way to reduce the not only the share volume and raise the price, but it also benefits the owners of the business because they get to own more without any penalty, right?
So
So yeah,
let
go
me
ahead.
stop you. Let me stop you there. Just to summarize, and I want to raise a couple points. Okay, so it's basically a way to reduce share count,
Mhm.
and that's how a lot of companies use it to return. When we say return excess cash to shareholders, you can basically buy back shares and reduce the pizza is sliced into million slices. You're reducing those number of slices down to from 10 to 9 million. So every person that gets a slice has a little bit bigger portion of that pie.
Right.
Um,
And the pie itself stays the same size, right? I think that's a big part of this, right? Is it
that's right.
in and of itself, it doesn't change the size of the pie.
That's right. Yeah, the pie stays the same. Here's the question: what are the arguments for what is the logic behind proposing this?
Yeah. So if you remember, one of the things I said was share-based compensation is a big part of companies' ways to compensate employees. So uh, executives and employees, right? So they may issue shares, right, which is dilutionary, right? It dilutes the number of shares outstanding. So your share of the profit goes down as an owner of the business. So they're on one hand doing that, and then on the other hand, they're offsetting it by buying back those shares. So the tax that they're proposing here is if you buy back 100 shares during a year, a calendar year, but you issue 50 shares for compensation during that year, the taxable amount is actually on the amount of money you spent on those 50 shares. And from that, you take 1% of the gross amount. So this is considered a excise tax, right? Which is the same kind of tax like on um, alcohol or gas, right? It's when you buy it at the pump, you pay an extra 1.08, or 8.25% or something.
So
Here, it's going to be 1%.
Yeah, that makes sense. I want to focus on the argument put forth by those who are proponent of the tax, because I think it would be good to talk about them. So why
Yeah.
is this? Why is this something? Why would somebody think that this is a good idea?
So there are a lot of people who are opposed or critics of stock buybacks because they seem to think that it's not a good benefit to the that companies aren't using that money to invest in new products, employees, etc. Right? And on it,
Can I add just one more thing?
yeah,
Invest in the R&D and the growth of the company. That's one thing.
right.
And I would say the other thing is that a lot of the executives, if you look at their compensation structure, I mean, majority of the executives are compensated by stocks and equity, equity piece of the company. And if you buy back shares with excess cash, their stock price will go up. And so I think in the eyes of those who propose this tax, it's just stock buyback is a gimmick. I heard that term thrown around a lot. It's a gimmick to juice their own return so that their share prices go up, and you know um, yeah, it's sort of like a shortcut.
Right. So let's take an example of a perfect business that used buybacks to their advantage. So AutoZone, is a retail company that sells auto parts here in the United States, and between like 2010 and 2020 or so, they revenue essentially doubled. Okay. And this is a company that doesn't pay a dividend, as far as I know, or a minimal one, but they used their excess profit to buy back shares. And the reason that they did that is that they had no place to really invest their money, right? There was AutoZone had stores pretty much everywhere. They were slowly growing their store count, but they couldn't really spend all of that money effectively to do it, right? And then hiring more people really wouldn't help them in this scenario, right? So the critics are saying that they should take that cash and they should give it back to employees, give it back to shareholders, and all of that stuff. And the reality of the situation is, if you look at AutoZone, they had a 10x return on their share price, because they basically reduced their share count by some very large amount, like 70% or 60%, right? And then by doing so and doubling their profits, in the same time, you basically got a huge, increase in your per share profit just because they did this buyback, right? So, anybody who's making that argument doesn't understand what is actually happening, right? Imagine if you were a employee of this company and you owned shares because they were given to you as compensation, right? A buyback is actually benefiting you tremendously. For without doing anything else, your share count reduction means you own more of the business, you get a bigger share of the profits, and your share price goes up, right? So you actually benefit as an employee. You
I think,
benefit as,
yeah, I think okay, so maybe I'll pose this question to make it very clear. Why would why would an executive and the board of directors decide to do a buyback versus a cash dividend? Because from the eyes of those, from the proponent of the critic, the critics will look at that and say, okay, you have excess cash on your balance sheet, you've made a ton of money, return that instead of juicing your own return. Instead of juicing your own return by buying back shares so that your share prices go up, why don't you distribute that to the shareholders?
yeah. So the problem with the dividend is it's a terrible way to return money to shareholders in almost every situation, because a dividend is taxed again as income. So imagine a company makes $100 in profit. Um, they distribute that money to and there's 100 shares for simplicity. That means every share gets $1 worth of earnings, right? Well, that $1 in earnings has already been taxed at the corporate tax rate. Now you go into the next um, phase of this where you pay out a dividend of, let's say, that entire amount gets paid out. Well, now each dollar is now taxed at the individual's tax rate. So essentially, this profit now is gone from been taxed at a 30+% tax rate on the corporate side. Um, and that number could be anywhere from 15 to 25%, depending on, you know, uh, what the corporation's basic, tax rate is. And then it's being taxed again when it comes to the shareholder.
At the
So this is
personal
not
level.
a great way to actually distribute money, right? And what you're doing with share buybacks is at a 1% rate. It's not a very large amount, but it's not a good way to actually. This is something we should actually be encouraging companies to do, because imagine if you are a pension fund or you're own a S&P 500 as part of your 401k, right? Everybody benefits from the price of a share increase, right? And that money is, if spent wisely, right? And that key phrase is important here. If a company's price, stock price is low, a share buyback is almost like you're like value investing, right? You're buying back shares of that's worth $1 for 50 cents, right? If it's half off, and and if it's overvalued, it's not a good use of capital, right? Most people don't take that into account. There are a lot of businesses that are perennially undervalued, like it used to be Southwest Airlines, NVR, which is a company we talked about, a home builder. AutoZone is one of those that is perennially undervalued, and their buybacks are doubly beneficial, because you're essentially getting more for your buyback than otherwise noted. So just to kind of get like back to this, right? This is not a good way for you know because it sets a precedent that we can, if we can raise this buyback tax in the future, and it may become a material amount of money that reduces the actual buyback, calculus for people.
Yeah, I think that was a good point there. Let's talk about the actual law. I mean, you touched on that really quick, but I would like to think about this or talk about this law and how the incentive now, because of the tax rule, how that changes. If you're sitting at, if you're sitting on the board of one of these companies, how does this tax change your calculus here? 1% tax, excise tax.
Well, I think excess profits are always going to be there for mature businesses. And what it may end up doing is, if it gets high enough, it may make the decision between dividend and buyback less uh, more difficult to make. Companies that were doing buybacks may actually just issue a dividend instead, right? And a lot of people think, oh, if I'm a retiree, it's better for me to get a dividend, because that's cash that's coming in, right? But I think the best businesses understand what the value of their company is, and then buy back shares below that value, right? Warren Buffett does this with Berkshire Hathaway stock, and lots of companies that are successful do that, right? If you look at the S&P 500, 27 stocks in the S&P 500 accounted for more than half of the buybacks, right? And we're talking about $1 trillion that's spent on the buyback every year. So this is a fairly sizable amount of money that's spent on buybacks, and it's what it's going to end up doing is it may shift where people are giving back money to shareholders, right? Because I don't think what it's going to do is force them to actually hire more employees or anything like that, because that's not beneficial to when you have excess profit. You don't want to reinvest it if you can't get good returns, right?
Yeah. In fact, yeah, yeah. I think. I think those are all like really good points. I think we can spend probably another, I don't know, 20 minutes talking about this. And in particular, I think we can talk about like, we could probably have another episode about the merits of stock buybacks, and maybe like the bad cases of stock buybacks, because we saw a lot of that happen in the last like 3 or 4 years, where the shares were incredibly overvalued. But I mean, some of the some of the arguments put forth against the stock buybacks, I think the examples I might cite are things that we observed in the last couple of years, where insane level of valuation, but they're still continuing to buy back shares. Maybe the better case might be for that is you maybe hold on to that cash reserve and put it somewhere else, because
Yep.
buying back shares when the PE is like a 30, 40 doesn't make any sense.
Right.
So I can probably spend another whole episode about this, but let's move on to something else. Let's talk about Disney
Yeah.
and the streaming business. Did you call it? Did what happened?
Well, so if you recall from earlier episodes, we talked about Netflix, and Netflix was kind of pioneered the streaming market. And what ended up happening with Netflix is, they were talking about how great they were and how they were going to, blow it off, blow the doors off of it and eat Disney's lunch and all this stuff. And, you and I talked how much they were spending on making new content because they had to keep acquiring customers. And eventually, the pouring money into the funnel and getting more people to buy, it ended up like people were just tired of it and said, well, I'm going to buy Netflix, or I'm going to get Disney Plus because I can just switch my streaming service every month, and I'll switch over to Disney Plus for a few months, or HBO Max, or whatever it is, right? And that's ended up happening. Competition hurt them. There's only so many eyeballs. I mean, if you remember, we talked about Netflix was saying their competition was sleep, right? Like that was how arrogant they were about like the market being like, people love us so much that they the only competition we really have is sleep. And Disney has a catalog of uh, going back 100 years almost at this point, uh, of stuff that people are watching, and and that kind of thing. And I think Disney is at risk of the same problem with Netflix, right? They got to get people to come onto the channel, but they also have, um, they also have to make money off of this, deal, and so they're starting to raise prices because they were putting low prices to entice people to come on. Um, so it's going to be a very interesting thing because Disney's going to have, had making a lot of money in other areas. Their theme parks was what actually drove a lot of this because they were shut down for 2.5 years, and then they were only operating at limited capacity. Now that they're in full swing, profits are coming back. People are coming back, spending money again on non movie stuff at Disney, and I think it's helping them. And and they're hitting on their streaming content also.
Yeah, I wanna just give everyone some numbers here. Okay, so combined, Hulu, ESPN Plus, Disney Plus have over 221 million subscribers. Netflix has 220 million subscribers. So there you go. Something that I want to maybe touch on here is the something that is sort of like, I think for you and me as entrepreneurs of our business, it is it is, I guess it's something that I've been really like experientially learning, which is that when you try to acquire a customer, the amount of money and time spent doing that, like marketing dollars and just your time and energy, sometimes those are not really accounted for. It's just like, yeah, yeah, we'll get the customers, and then the customer pays, and then boom,
Yep.
profit. It doesn't work that way, right? You have to take into account all of the marketing dollars spent. I mean, that's what people call customer acquisition cost, right? CAC.
Right.
And that is insane for businesses that are just starting, right? Because there's
Right.
nothing. You don't have anything to stand on. You don't have brand. You don't have anything. So Netflix spent a ton of money on marketing. They also spent a ton of money on creating new content. And this is the point, creating content. This is the point where we talked about in the episode where we talked about Netflix and
Yep.
Disney, was that what Disney has is insane because their content is is evergreen. It's
Right.
evergreen. You make one, and then the kids watch it. Kids watch it over and over again, and then let's say you grow up, you have your own kid, they watch it, and it's multi-generational content.
Yep.
Netflix is sort of like a cheap plastic product. It's like one and done kind of thing,
Right.
even though it costs so much money. And what's interesting about this whole thing is that Netflix never made any profit in its entire
Yep.
history.
Yep.
Um,
And have a lot of debt now too, also, right?
yeah, and now like what is going to happen to them, right? It's like the share price has plummeted, and they're now looking at ad business. Ad business is just like, I mean, for me, and I think for you too, the incentive structures are totally effed. I mean,
Yep.
you're not really serving customers who are watching your. There isn't a direct incentive. Now your customers are these ad buyers.
Right.
It's, so
Well, and the other interesting part about that is their entire business model was on hours watched and these kind of things that they never shared with anyone. And now that they have to have advertisers, if they put an advertising tier, they have to share that information. So, Netflix would have, a movie that maybe flops on their thing, but say they could call it a success, right? But now, advertisers are going to have to target specific shows, right, that they want to watch. And so that's going to affect, how they invest in content. It's going to change the nature of their business, right? Even though a, a ad-free version, right? It's going to taint the ad-free version also, just by the nature of some people are going to want to advertise on certain shows and not, right? And so I think the thing is it's fundamentally changing their business in ways that people aren't understanding. And Disney Plus is going to be offering an ad based version also. And I'm curious as to what is going to happen to that business, right? Because I wonder how it'll change Disney Plus also.
yeah, it makes me wonder. I mean, I feel like, I don't know. We can talk about this again. All these topics could deserve a podcast on its own. But I feel like Disney. I mean, if I were sitting on the board, if I were on the exec team, I mean, obviously they have more data than what a plebe, this couch, armchair
Yep.
investor. I mean, I feel like it would be a mistake to go down the ad model if Disney. I mean, I feel like people would be willing to pay a little bit more for their content. I feel like that would be a
Right.
mistake. Anyway, okay, let's talk about last topic here: the state of the economy. Inflation number came out again at a point. What is it? 8.5
Yeah.
for the month of July.
Yep.
Let me pull this up.
I think it's 8.5% in July, so down from 9.1.
Mhm. So, I mean, maybe just paint a broad picture of what this mean. I mean, every news right now is talking about inflation, inflation, inflation. Okay, we've heard it enough. It's like, okay, we're in. Everyone feels it. What's
Yep.
this? Where do we go from here? Bank of England raised their interest rate, benchmark interest rate. Maybe it was it Monday or last week. Yeah, August 4th. How do we make sense of this?
Well, I think I think we talked about this on the last week's episode about how inflation impacts people in different ways, right? Different rungs of society have a different impact on. So, like, Walmart shoppers are impacted more by rising food prices because they have less disposable income, and so when you raise the price, it impacts them. And if you look at the high end of the market, right? Samsung, who makes smartphones, they're saying that most expensive phones are growing by 20% year over year, right? So they announced their most expensive handset was like $1,800, and they're expecting 20% growth in that uh, smartphone segment. So there's this dichotomy, right, that we're seeing in terms of there are people who are currently employed, making a lot of money. A 10% rise in their food prices, is not a big strain on their budget, right? And then you're seeing in the US, a lot of people on the lower end of the socioeconomic spectrum who have that 10% is essentially wiping out their monthly discretionary spending, right? So they're cutting back on a lot of things. And I think even in between, right, you're seeing people cutting back, right, on spending. And that's why Walmart was cutting jobs. And we went through a laundry list of those companies last week who are cutting jobs, even in the tech sector, right? We're cutting jobs.
I mean, is this basically, are we in stagflation? Is this
So
do we tell I don't know, do we tell our kids in the future that, oh, we went through a period of stagflation when they learn about it? Is this it?
I think it's going to come because with high inflation, I don't see that oil and gas prices are going to come down, when until demand comes down, right? Demand is starting to come down a little bit because that actual drop from 9 to 8.5 was mostly energy, because energy was the one that was causing most of the inflation. Uh, so I think we're already looking at 2 quarters of negative growth. That's already in the books now. So we are technically in a recession. And I mean, I think you have to call it stagflation, right? Because it's inflation plus stagnant growth, right? So it's just a question of how much impact is this going to have and for how long, right? And, are there going to be a big, you know, is there going to be like a Lehman Brothers style like bank that goes under, or big company that goes under that then has a ripple effect across multiple areas, right? Or does some country in Europe have cause a problem, a tipping point for the rest of the world, right? That's also a possibility.
Yeah, I mean, if I were to speculate here, this is, again, complete armchair like speculation. I feel like something's going to break in Europe. I mean,
Yeah.
it doesn't look very good. I mean, if any of you are watching in Europe, like, comment below what you think is going on there. I think I would be interested to hear your take on this.
Yeah.
Great.
One thing I would add to that is that we haven't talked about it much on this call, but or the stream, but we'd love to hear from you guys, like during the stream or afterwards. So if you can comment on anything we talked about. Last week we had someone comment about covering DaVita, the healthcare company that. So we're planning on doing that next week on the podcast. So we'd love for you guys to like comment about, share with your colleagues, and that would really help us out as we try and keep this thing growing.
Yeah, definitely would appreciate all of your likes. Please do that at the bottom, and comment definitely helps. So we appreciate any help there. All right, so let's wrap it up. I think that is it for today's episode. I hope it was entertaining one, and valuable. And hope you guys hope to see you guys next week, Thursday. All right,
All right.
take care,
Thanks,
guys.
guys.